Funding rate arbitrage on crypto exchanges. What is it and how do you do it? I personally did it for the last 30 days and I actually made $1,000 on a $20,000 capital. Now, before people start going crazy, bro, 1,000 on 20,000 is absolutely nothing. Oh, that's just disgusting. All these different things. This is zero risk. Now, what zero risk means, it's not like buying a stock where the stock can go down and you could potentially lose $1,000. No, this is literally zero risk. And throughout this video, I'm going to explain to you how is it zero risk, how does it work, and how you could execute it yourself. Here's exactly how it works. Oil is a perpetual contract on OKX, Gate.io, Binance, Bybit, MEXC. Every single one of these exchanges runs a funding rate. Funding works like this. Every 4 hours on OKX, every 8 hours on Gate, the exchange will look at how the perpetual price is trading versus the spot price. If longs are too aggressive, the exchange charges longs and pays shorts. If shorts are too aggressive, the exchange charges shorts and pays longs. It's a single number recalculated 3 to 6 times per day, depending on the exchange. And it's the lever that keeps perpetual contracts pinned to the real oil price. Now here's where it gets interesting. Over the last 30 days, oil moved a lot. So that funding rate also moved a lot. On OKX, adding up every 4-hour funding event over 30 days, the cumulative funding paid to longs was 6.08%. On Gate, the same exact perpetual, same 30-day window, but at an 8-hour cadence, cumulative was 3.51%. Two different exchanges, same product, 2.57% spread. The trade: long the contract on OKX, short the contract on Gate, collect the OKX funding, pay the Gate funding. You net 2.57% over 30 days. It doesn't matter what oil price does. If you're long and short at the same time, you're delta neutral. Multiply that by a 6x leverage, $20,000 in capital. You net $1,448 after fees over 30 days. That's 94% APR. It's insane. Concrete number, 5 months T-bill yield in 30 days. Now here's where most find the ARB videos lie to you. They don't show you the 30-day cumulative and they pretend the trade pays evenly. It doesn't. That 6.08% on OKX wasn't paid 6.08 spread evenly over the 180 funding events. Most of those 180 funding events paid you cents. The trade lives in clusters. Cluster number 1, April 28th to 29th, oil ran from $95 to $110, a 16% rally in 48 hours. The 4-hour funding rate on OKX flipped negative to 0.074% per day average. Retail longs piled in to chase the rally. Counterparties paid them $7 per 10,000 per 4-hour funding period. Cluster 2, May 7th through May 13th. Oil dropped from 95 down to 89.50 in 1 week. Retail longs that didn't get out panicked. Funding rate hit negative 0.141% per day. The peak single event was negative 0.38% in 1 4-hour period. That means on every $10,000, you would have made $38 guaranteed in one funding payment. 5 individual events out of 180. May 7th, 8th, 11th, 12th, 13th, each one of them paid you $30 per $10,000 of position that you were in. Just those 5 events drove a third of the entire month's profit. That is the pattern. The trade doesn't pay you because it's always available. It pays you because oil moves. And when oil moves, retail longs sweat. The funding rate spikes and you collect. When oil is calm, like right now, May 25th, the funding rate sits at 0. Looking at the last 5 funding events on OKX, you see it's been 0, 0, 0, 0, and 0. The trade isn't dead. It's dormant. It's waiting for the next move. And here's the connection to my last video. I went back and ran the 12 numbers, the 12 Truth Social posts move oil in the last 60 days. 12 out of 12, 11 had the funding rate go negative within 24 hours of the post. 11 out of 12. The biggest funding event of the entire month, May 10th at 4 p.m., landed exactly 24 hours after Trump posted it's totally unacceptable about Iran's counterproposal. Negative 0.3% funding on OKX. $30 per $10,000 in position in every 4-hour period. Trump posts didn't directly create the funding spikes. They created the volatility. The volatility scared the retail longs. The retail longs paid the shorts. The pattern is casual. Every Trump-driven oil move pulled the funding rate negative within a day. So the entry signal isn't when is funding high right now. The entry signal is when is oil about to move. Trump posts, Iran headlines, OPEC meetings, inventory data, anything that shakes the retail positioning. Most people see this and think that's free money on a crypto exchange, but that's not what happens. There's a structural reasoning behind the edge. Real oil trades on NYMEX and ICE are trillions of dollars per day. The natural shorts in oil are commercial hedgers, refineries, airlines, shipping companies, people who own physical barrels. None of them moved to crypto perps. They use CME and ICE. Prime broker relationships cleared swaps. They're not opening accounts on Bybit. What did move into crypto perp oil? Crypto retail going long for the same reason they go long on Tesla, exposure without having their main exchange. When retail piles in long and commercial shorts don't show up, the funding rate flips negative every time the price moves. Shorts get paid by longs. The edge exists because Bybit launched oil perps in mid-2025. The natural shorts haven't migrated over yet. Probably another 6 months, then the trade compresses permanently. Onto leverage. At 6x leverage, you make $1,448 per 30 days. Why not 10x? Why not 20x? Because oil moves. Same volatility that pays you in funding will liquidate you in price. From April 25th, crude rallied 16.3% up to 110 in 3 days. At 10x leverage, you would have been liquidated on a 10% move. Your short leg also dies on April 28th. Exactly 3 days into that trade, you lose your $10,000 short margin. Your long leg on OKX is now naked. You eat the next 6% move on a single side. The total damage would have equated to $13,000 to $15,000. So the real question isn't what's the maximum leverage I can set. It's what is the highest leverage that survives the worst price move in the window. For WTI oil, the last month that was 6%. For Bitcoin in the same window, 14x. For gold, 18x. It barely moved 1.4% intra-month. Now here's how to actually trade this. Don't watch the funding rates, watch the volatility. When oil makes a 3+% daily move in either direction, retail longs panic, funding rate spikes negative. The spread opens between exchanges, and that's your entry window. You have roughly 8 to 24 hours after the move to deploy funding rates before they start mean reverting. You hold for 3 to 7 days, collect the spread on every funding event, close when funding drops back near zero. Average trade window in the last 30 days, 4 days, and the average profit per trade window on $20,000 at 6x is $300 to $700 depending on the cluster size. For finding the volatility itself, Trump Truth Social, Iranian state media, that was the whole point of my last video. OPEC meetings, EIA inventory releases at 10:30 a.m. Wednesdays, anything that shakes retail positioning on oil perps. 3 more places this same pattern lives right now. 1. Brent crude oil, same 4 exchanges, slightly tighter spread, roughly around 1.7% over 30 days instead of WTI's 2.6%, but it's the same exact playbook. 2. Silver, smaller money, but the funding rate on Bybit versus OKX still pays a little. Lower leverage required because silver moves less. 3. Hyperliquid's S&P 500 perpetual. Hyperliquid lists 230 perps, 229 of them are crypto, 1 isn't. When the next equity correction hits, watch the SPX funding rate. Every new perpetual listing is a candidate. Free dashboards, CoinGlass, CoinAnalyze let you monitor cross-exchange funding rates in real time without an account. Crypto traders are missing the easiest trade in their own market because they're staring at chart patterns. Meanwhile, the order book is screaming at them. Pay me to take the boring side while retail sweats. The next opportunity comes within 30 days, maybe even sooner, when the next big oil event hits, or the next stock market panic, or the next new perpetual listing. Watch the funding rates before you watch the price. The price tells you what already happened. The funding rate tells you what is about to happen.